Michael Widmer is head of metals market research at Bank of America Merrill Lynch, and the bank has raised its 12-month gold forecast to $2,000 an ounce. Michael, thank you so much for coming in. 2,000. This is basically because you expect the equity markets to do very poorly and quantitative easing in the United States.
I think it's a combination of factors. Equity markets, I think, as you see this morning, do play a role in the call, and we are not too bullish, right?
Yeah.
I mean, we have $200, $250.
No, actually, at this point.
Exactly. So, I mean, because of that, we didn't go much higher. I think the reason why we are calling for $2,000 gold is that a lot of the issues in the global economy, in our view, are structural issues, particularly when you're looking at the debt side in advanced economies. And really, what you have to say is governments in the US and the Eurozone, to some extent, they are in a no-win situation. What you do have is an environment where markets force governments to tighten fiscal policy, which governments know will have an impact on economic growth. On the other hand, the issue is that the private sector is not strong enough.
But is this an asset bubble? Is gold, because, you know, we were speaking to Mr. Soros 6 months ago, right before he sold off gold, and of course there's a concern that as soon as interest rates goes up, as soon as a little bit less fear on the markets and people, you know, regain a bit of confidence, then gold will just drop.
I think there's given the price rise that we've seen, there is a risk of increased volatility on the gold market. But again, if I look at the global macroeconomic environment right now, I don't think that market participants necessarily buy gold because they
are scared.
Because they see further price rises ahead without the fundamental support for that. I think there is real fundamental support out there, and that fundamental support comes from the issues on the debt side in the advanced nations.
How much does the fact that certain central banks are actually buying gold just because they can hold on to something change also the name of the game?
Oh, that is a big contributor to the price rally. If you're looking back a few quarters ago, particularly the European central banks used to be a relatively sizable seller in the central bank gold agreement, and they have all but stopped those sales. And emerging market central banks have actually become much more active as buyers. So central banks are net buyers at the moment. And again, if you're looking at some of the issues that you do face on the fixed income markets, you can see how interest from the central banks in gold as an asset class is there, right?
But Michael, if you look, okay, let's say that it does go to 2,000, which you're right, it's about $250 off the mark now, so it's not that further ahead like we would have thought, you know, a year and a half ago. So let's say in the next 12 months it goes to 2,000. What happens afterwards if interest rates then go to 4 or 5% because inflation is taking control and we have nice growth? Is it going to drop back to 1,200?
Yeah, the issue that you have is that gold is a non-yielding asset class, right? I mean, if you hold gold, you can do it for a pure precautionary motive, or you do it because, for instance, you expect price rises. Now, those investors that did buy gold because they anticipated price rises, and you can see an environment like you just described where gold prices rise a little bit less strong or potentially have got less fundamental support. I think in that environment you could see that the rally takes a little bit of a break.
But it's still a rally, or are we going to have a huge correction? Are we still going to be, what kind of range can I see in the next 2 years?
No, this is the thing. To me, really, there is, from a structural perspective, given the debt issues, there is
here, yeah.
I mean, we have called for a seven-year price range of around $1,500 to $2,000 pounds at the same time. So within that range, I do see that you could have relatively steady support. Let's put it this way: if gold prices fell back towards $1,500 or $1,000 pounds, you would see potentially a relatively big reaction, for instance, from the jewelry market.
Yeah, of course.
So you do have support from that side as well.
And Michael, just very quickly, when do you think it will touch 2,000? Can it touch it before the end of this year?
It's potential. I think there is one risk scenario that is starting to shape up, and that is the negotiation of the concrete measures in the U.S. fiscal package, right?
Yeah.
Which is now coming up, and as that evolves, you have got already some news out there that it may not go quite as smooth as markets would have wanted to be. And I think if risk aversion rises on the back of that, you could see gold prices.
So we could have 2,000 in the next month.
Well, next month, I think we call it fourth quarter is probably a decent target for
all right.
time-wise.
Michael, thanks so much. Michael Widmer there.